As the U.S. stock market is currently closed for its regular trading session on this Saturday, November 1st, 2025, we are looking at the final closing print for BURU Inc., ticker symbol BURU, from a very active session yesterday, Friday, October 31st. The stock finished the day at 33.86 cents. That was a very slight gain of just 0.0009 or about 0.27%. But that single closing number tells almost none of the real story. In fact, if you're still looking at BURU as just a struggling blue laser company, you are already months behind what is actually happening. This is no longer just a hardware play. It's an aggressive, high-stakes, and incredibly controversial attempt at a complete corporate reinvention. The market is buzzing and the retail chatter is deafening because this tiny sub-dollar stock is now in the middle of a massive pivot into defense, security, and software as a service, all while its financials hang by a thread. This is a story of transformation or desperation, and the line between the two is getting thinner every single day. The expectation from the market, for the most part, has been that BURU is a dead-end experiment. This is a company that came public, like so many others, with a promising technology, its unique blue lasers, but then proceeded to burn through cash, miss expectations, and watch its stock price collapse from dollars to pennies, landing it in hot water with the NYSE for non-compliance. For most of 2025, the common belief was that this was a slow walk to delisting or bankruptcy. But the reality is that behind the scenes, a completely different and, frankly, wild new company is being bolted onto the old one. Just yesterday, on Halloween, BURU announced it had completed the first phase of a major acquisition, taking a 10.7% stake in an Italian software company called Orbit SRL for $1.5 million. This isn't a laser company. Orbit is a software platform for operational resilience and crisis readiness. This is a full-blown software-as-a-service or SaaS play. This move is the centerpiece of a new BURU Defense LLC hub the company has created. It's not just a small side project, this is the new strategy. They are simultaneously advancing a joint venture with Maddox Defense to work on drone technologies and leveraging another partnership with a firm named Techne SPA to secure international defense contracts, one of which is a reported $6.6 million deal in Bangladesh. So while most investors were watching the stock bleed out, management was trying to perform radical surgery, grafting a defense and software business onto a failing hardware body. This is the new narrative they're pushing, and it's what's causing the insane trading volume we saw yesterday with over 101 million shares changing hands. This move has retail investors completely split, and the sentiment is explosive. On one side, you have a deeply frustrated group of long-term holders who feel betrayed. They bought into a pure play on revolutionary blue laser technology. Now they own a complex, confusing holding company with a drone JV, an Italian software stake, and a legacy laser business. This frustration was thrown into overdrive in mid-October when the company received a public warning letter from the NYSE American Exchange. It wasn't about the stock price. It was because the company announced its new dual CEO structure and transformation plan during market hours without giving the exchange the required advance notice. To retail investors who already feel like the game is rigged, this looks incredibly sloppy at best and deeply suspicious at worst. It feeds right into the online chatter of manipulation and incompetence that plagues so many microcap stocks. The appointment of two new co-CEOs, Alessandro Zamboni and Dario Barassoni, effective October 1st, each with a $440,000 base salary, also raised alarms for a company that was, as we'll see, practically out of cash. But on the other side, this pivot is pure catnip for a different kind of trader. This is a second chance narrative, a turnaround story that could, in theory, take a 33-cent stock and send it flying. This new crowd sees defense, drones, and SaaS, and their eyes light up. And they have a clear enemy to rally against: the short sellers. As of the last report, BURU's short float was sitting at a very high 15.50%. This is the key. You have a massive, new, exciting story hitting the wires. You have colossal trading volume, and you have a significant short position. This is the classic setup that retail traders on platforms like X and Reddit look for. They aren't just betting on the company's fundamentals, they are betting on a squeeze. They're hoping this new defense narrative is powerful enough to ignite a buying panic and force those 15.5% of short sellers to buy back their shares at any price. The tension between the frustrated original investors and the new squeeze-focused traders is palpable. The company's future might as well be a secondary concern to the immediate battleground of the 15% short float. Now, we have to ground all of this in the cold, hard numbers, because the expectation of a turnaround is running headfirst into a brutal financial reality. When BURU reported their second quarter numbers for the period ending June 30th, 2025, the situation was beyond dire. The company had an accumulated deficit of over $150 million. It posted a net loss of $12.2 million. And the most terrifying number of all, it had just $111,090 in cash and cash equivalents. That's not a typo, $111,000. The filing contained the single most feared phrase in finance, a going concern warning. This is the company's own auditor stating there is substantial doubt about BURU's ability to continue operations without raising more capital. This is the reality that underpinned the stock's collapse. Now, to be fair, the company did address this. In September, they announced the completion of a $12 million public offering. As of late September, their cash position was back up to approximately $6 million. But this is where the story gets even more complicated and, for many, deeply concerning. That $6 million in new shareholder money isn't just for keeping the lights on. It was explicitly raised to deploy the acquisition program. And here is the fact that is causing the most debate. That Italian software company Orbit SRL that BURU is in the process of buying, it was wholly owned by Alessandro Zamboni, BURU's executive chairman and new co-CEO. This is a related party transaction. The new co-CEO is using $1.5 million of BURU's recently raised cash as a first payment to buy his own private company. The company has been clear that this was all reviewed and approved by independent directors. The bull case is that this is a brilliant move. Mr. Zamboni, an insider, believes so much in the synergy that he is merging his own asset into the public company, aligning his interests with shareholders and fast-tracking the pivot to a high-margin SaaS model. The bear case, and it's a loud one, is that this is an appalling use of shareholder capital. It looks like an insider enriching himself using precious life-or-death cash raised from public markets to buy his own private asset at a valuation set by his own board. This is the central conflict, and it's what's making BURU one of the most controversial stocks on the market right now. So I have to ask, comment below, do you think the Orbit acquisition is a genius pivot by an aligned CEO, or is it a massive red flag? It's important to remember what BURU even was in the first place to understand why this pivot is so dramatic. The company was founded on a genuinely interesting and potentially valuable technology. Its blue lasers operate at a wavelength that is much more readily absorbed by reflective metals like copper, gold, and aluminum compared to the traditional infrared lasers that dominate the industrial market. This is a big deal for welding battery components for electric vehicles, for 3D printing with copper, and for consumer electronics. The problem was never the tech, it was the business. BURU is a tiny fish in an ocean of sharks. Its main competitors are multi-billion-dollar giants like IPG Photonics, Coherent, and Trump. BURU simply couldn't compete on scale, cost, or market penetration. It was a classic case of having a great invention, but a failing business model. The pivot to defense and software is therefore an admission that the original blue laser business model as a standalone company has failed. The laser tech will now be one component of a larger defense offering, not the entire company. Looking forward, the future of BURU rests on two completely different possibilities, and there is almost no middle ground. The bull scenario is that this pivot, while messy, actually works. Management's expectation is that these new business lines, primarily the Orbit software, will start generating billings of around $500,000 in the fourth quarter of 2025. If they can show that this SaaS model is real and growing, and if the drone and defense ventures with Maddox and Techne secure more contracts, they might just pull it off. They could build a new, profitable company from the ashes. If that happens, the 15.5% short float will be annihilated, and the retail bulls who bought at 33 cents will be vindicated in a spectacular way. The bear scenario, however, is far more likely from a statistical standpoint. The pivot could just be a desperate, expensive distraction.
The $6 million in cash will be burned through paying the new dual CEO salaries and funding these new ventures, which may never produce meaningful profit. The Orbit acquisition could be a black hole for capital. The company will be forced to dilute shareholders again and again just to survive until the NYSE finally runs out of patience and delists the stock for good. So to summarize this entire complex situation, the expectation is that BURU is just another dying microcap penny stock. The reality is that it's the site of a high-risk corporate experiment. It's a battle between a legacy cash-burning hardware business and a brand-new, unproven defense and software strategy. It's a story defined by a going concern warning, a massive 15.5% short interest, and a deeply controversial related party acquisition by its own CEO. This isn't just a stock, it's a gamble on one of the most aggressive and risky turnarounds you will ever see.